We put together an option jive. This is our first piece of research today. The first thing we're talking about today is the probability of a stock to retrace. What is the probability of a stock to retrace after it's had a big move? Do you think it's anything other than random?
Yeah, I would. That's a good call. It's probably random. It's hard to, like retrace back to highs or retrace to where it was prior to.
Well, usually we're talking about kind of more like this,
like earnings, like an earnings.
This is another name for like mean reversion. It is challenging to predict the direction of stocks within a particular time frame. At any given moment, the movement of prices can be very random. We put 3 stocks up here. It looks like Rivian, XLU, and NVIDIA. The reason they put 3 stocks here is they wanted one that was in an upward trend, one that was kind of going sideways, and one that was going down. Rivian was going down. XLU, which is a utility index, was going sideways, and NVIDIA was obviously trending upwards. So despite the recent parabolic move in the market, there remains a chance of price correction. There always remains a chance of price correction, or increases in volatility. Traders who seek a neutral position without a specific direction in mind may be curious about the probability for a stock to retrace to a certain tight range or its original price.
Okay.
Now, we know that markets are cyclical about, let's call it 80% of the time. About 15 to 20% of the time, markets move outside of their predictable ranges.
Yeah.
About 80% of the time, they stay in some range. So it is reasonable to assume that the amount of predictability with respect to retracement is going to be
same around.
It's going to be upwards of. It's going to be somewhere between 70 and 80% in my mind.
Yeah.
Over time. So we conducted an analysis of the SPY for each 45-day cycle and recorded the probability of an underlying price returning to its initial price point on a daily basis. Okay, well, returning to initial price is a little bit more constrictive, okay, because that's asking for like almost a full retracement.
Yeah.
But normally, it's part of it or something like that. So this will be a little bit less, I assume. I'm just guessing. I have not seen the results. The probability of a stock returning to its original price decreases quickly as time passes, meaning that in the very short term, there is a high likelihood of price cyclicality.
Yeah.
But as the stock goes up, like using NVIDIA as an example, as the stock goes from 600 to 800 or 900 or 1,000, it's not going back to 600.
Yeah, it continues with its movement. Yeah.
Yeah.
Gotcha.
So that's all okay. That's all super interesting. We're there. So on average, prices revert back to their original trading value twice within a period of 45 days. However, the probability doubles if the positions are managed at 21 days. Okay, they're going back to a specific price, the original price. I guess the reason they did this is for, because it's easier to code. The occurrences that price went back to being unchanged. If you hold to expiration twice, if you manage at 21 days in a 45-day cycle.
So it's saying that 5 times over the occurrences? No, the high.
Yeah, they're saying that.
It took 23 days.
No, they're saying that in the mean of this happening. So if you looked at almost 19 years worth of research, okay, the number of times that you sold something, and if you manage it 21 days, it goes back to that original price.
Oh, the value. Okay.
Is 5 times in 21 days.
Okay.
The most it's ever done in 21 days is 23 times.
Okay, that's pretty wild. That's a lot.
Yeah. That's crazy.
Yeah, that's a little weird.
That worked out really well for selling premium.
But that makes total sense. Like a lot of times you hold a position and you might see a 10 or 20 or 30 cent winner after a couple days, and then you get a big move in the market and the position is back to flat. I mean, that happens all the time.
Yeah, I thought they were going to talk about just total retracement, like percentages of retracement. This is different.
Okay.
This is going back to the original price.
Got it.
Interesting.
Got it.
Okay. Obviously, that's another argument for managing at 21 days. And because if you're talking about one every 4 days, that's a reasonable assumption to make.
Yeah.
To go back to the original price.
Yeah, once a week. So, I mean.
Yeah, once a week.
Yeah.
No, it's more than once a week. Because
I mean.
5 times in 21 days.
Yeah.
It's almost twice a week.
Yeah.
So reverting to the exact initial price point may seem too good to be true for neutral traders. So what about tight swings between the two strikes? Tight swings. So historical data shows that for a 45-day, one standard deviation SPY strangle, the average call strike price is approximately 4% of the underlying price, while the put strike is 12%. So let's examine the likelihood of the underlying price remaining within a relatively small range, 1, 2, or 3% of the time at 21 days to expiration and at expiration. This should be more in line with my original thinking. Closing positions at 21 days to expiration has significantly higher chance of a stock staying within a tighter range compared to holding to its expiration. So the percent of the time a stock stays within a price range of 1, 2, or 3%. So 23% of the time, if we manage the 21 days, which we do, it's 23%, 54%, and 3% is 68% of the time. Now remember, if you sell a strangle, you're selling it at 4 and 12% out of the money. So these are all inside of that. Plus you collect that premium.
Yeah, this is just an example of implied volatility. Implied volatility is high, and as time passes, you typically see a contraction in volatility. Value contracts, and it makes complete sense that that implied volatility would be overstated relative to realized, which is what this slide is saying.
Sure, but it's good to know what the numbers are at 1, 2, and 3% because we don't play for a 1% move. Like if you're doing like let's say a really tight iron condor. Okay, now 23% is kind of your window.
Yeah. If
you're doing a wider iron condor, but it's a 50-50 shot, you got a 54% chance. Yeah. And if you're going wider to 3%, you really want to go out to that 4%, so you're at the expected move, because that's where you get the close to 80%. So some of the takeaways: managing positions at 21 DT has twice the chance of a stock returning to its initial price compared to holding to expiration. And exiting a position before expiration increases the probability of a stock remaining within a narrow range, which is beneficial for premium sellers. The main takeaway from all this was manage your trades early. No hero crap.
It's all the same. We've been talking about this for how many years now? 13? We got 13 years?
No hero crap.
No hero crap. I like it.